I'm very glad to welcome Giacomo Corneo, and he's professor of public finance and social policy at the Free University of Berlin. He studied economics. In Milan, he received a PhD in Rome and another one in Paris. And finally, he habilitated at the University of Bonn. He was teaching in Paris, in Bonn, in Osnabrück, and also served as a senior advisor in Paris. He is very active scientifically. He is actually the managing editor of the Journal of Economics, associate editor of the International Review of Economics, and also he published really high levels, for example, in the American Economic Review. Now actually, he's just finished a book, Eine bessere Welt, a better world, so he will present us with a vision of a better future, which will be more democratic, more pluralistic, and characterized by less inequality, he says. So his point of view seems to be citizens are not an obstacle, citizens are the solution. Thank you very much. The stage is yours.
Thank you very much. I'm very glad to be here and to have the opportunity to present a few ideas about an ambitious proposal. Here's the title. What is this about? Well, Europe has a project of a good society, that reaches beyond laissez-faire capitalism and also beyond the model of a social market economy. It is a project based on real participatory democracy, a dynamic and pluralistic market economy, and a fair and generous welfare state. Currently, this great project is threatened by an increase of income and wealth concentration that is slowly turning democracy into plutocracy, the market economy into a gambling casino, and the welfare state into a poorhouse. Unfortunately, this increase of inequality is not a temporary phenomenon. According to the French economist Thomas Piketty, it is structurally driven by a large and persistent gap between the rate of return on capital, R, and the rate of economic growth, G. He claims that unless we manage to increase capital taxation so as to bring down the after-tax rate of return to capital to the level of the growth rate, we might re-experience the resurgence of a kind of rentier society in Europe, like the one it existed in the 19th century. And in that case, a minority of heirs would be both those who held economic and political power. And this would be the negation of the project of a good society that we are striving for in Europe. I am not convinced. I am not convinced by Piketty's claim that capital taxation is key in order to stop the polarization of our society and to save the European project of a good society. For one thing, it is very difficult to win elections promising higher tax rates, even if those taxes should be paid by a minority of the voters. For another thing, it is well known that in a globalized world, taxation of capital is ineffective unless it is internationally coordinated. Otherwise, capital can simply flee to low-tax jurisdictions. Finally, even if we managed to solve those two political problems, I argue that a solution based on high capital taxes is not meaningful because of economic reasons. And this is due to the sheer magnitude of the tax rates that are required in order to restore the equality between the after-tax rates of return and the growth rate. We are thinking of rates of return on capital pre-tax of the order of 6% per year, at least. If we assume that the growth rate is around 1.2%, then mechanically, you would need a tax rate on the returns to capital equal to 80% in order to equalize those two variables. And this would simply be an average tax rate. If you want to have progressive capital taxation, then taxpayers who are wealthier than average should be paying close to 100%. And of course, with such high tax rates, we would have devastating effects on private investment and initiative. So I do not think that higher capital taxes are the solution to our projects, to our problems, and the solution that enable us to pursue our project of a good society. However, it is also not a reason to resign. It is not a reason to accept the increasing divide of our society. Actually, the limited scope of capital taxes simply implies that the required amount of redistribution has to occur already before the taxman takes his cut, at the level of the distribution of primary capital incomes. And this is possible as soon as a sufficiently large fraction of the capital stock is collectively owned, because in that case, the primary incomes from capital would accrue to the public budget and could be uniformly redistributed to the citizenry, which would reduce inequality. That is to say, the need to stop the increasing polarization in the wealth and income distribution and the limited scope of the tax instrument justify an enhanced role of public capital in our economic system. Enhancing the role of public capital within our economic system will allow us to solve the problems we face. This is the thesis that I'm going to defend in my talk. And if we do that, then capital tax rates may be raised, but by a much lower amount than suggested by Piketty. And this would be much better for economic growth. So, whereas the idea of enhancing the role of public capital in a market economy is, I think, a rather straightforward one, it is not very much discussed in policy debates. And I think that this has much to do with the experience of managing public capital in real socialism. That was a nightmare experience that nobody would like to repeat. But during the last couple of decades, there has been very interesting research on novel institutional arrangements that could allow the polity to collectively manage in a democratic and efficient way public capital. And I will draw from that research literature in order to offer you a blueprint of how, first of all, we could build up, in the first place, a public capital, and then to describe novel institutions that would allow us to solve the problem of managing public capital in a democratic but also efficient way. So let me briefly tell you a few things about how to build public capital. Of course, I'm not pledging for expropriations. This is a very bad instrument. But there are alternatives. I think that privatization of some public assets, moderately higher capital taxes, and a new emission of public debt are reasonable instruments in order to raise public money that could be used in order to buy worldwide stocks so as to build a diversified portfolio. Such a stock portfolio would be the public capital with which the polity would try to pursue its goals. So, since I have not very much time, and because I think that we have a window of opportunity, let me briefly discuss the potential of a new public debt in order to build a sufficiently large public capital stock. So what I suggest is that countries with a high financial reputation, like Germany or Switzerland, or a community of such countries, emit public debt in the international financial market and use that debt in order to buy stocks worldwide. So this, of course, raises the issue of the sustainability of public finances. Now, in the current situation, those countries can borrow money at a risk-free interest rate. And even long-run governmental bonds of those countries command a very low interest rate, which is close to zero. That is to say, the interest rate which is paid on the public debt is lower than the growth rate. If this situation persists, this means that refinancing the public debt over the long run, simply because the interest rate stays lower than the growth rate, will lead asymptotically to reduce to zero the ratio between the amount of newly emitted debt and GDP. Of course, a safer assumption is to think that this is a temporary situation, that in the future, sometimes there will be a switch and the interest rate on governmental bonds will be higher than the growth rate. In that case, I propose to follow a second strategy in order to keep public finances in check. Well, we can use the returns earned on the stocks in public ownership, and a small fraction of the returns from the stocks would suffice in order to cover the financing costs for the newly emitted debt. For instance, if the rate of return is 8% and the interest rate is 2%, then you need just 1/4 of the returns on the stocks in order to cover the financial costs of the government. And this means that as long as the growth rate remains positive, again, gradually the ratio between the newly emitted debt and GDP will tend to zero. If even this strategy is thought to be too risky, then I suggest a third possibility, which is that the government announces that the difference between the earned rate of return on the stocks and the interest rate will be prioritized to repay the principal. And this would mean that in finite time, the absolute amount of debt would be brought down to zero. So for realistic values of the rate of return on stocks and the interest rate, I think that after about 15 years, the newly emitted debt will be entirely repaid. So that starting from that time onwards, the polity will dispose over a public capital stock in form of a diversified portfolio without any associated debt. So what should the polity do now once it has such a public capital? Initially, the public wealth should entirely be managed by a sovereign wealth fund. Sovereign wealth funds are financial vehicles in state ownership that invest public money in the international financial market, trying to earn a possibly high rate of return. So they act as a collective rentier. So if a country like Germany or some countries of the Eurozone would establish such a sovereign wealth fund, they need a proper institutional arrangement so that such a novel institution would work properly. I suggest that 3 features are key in order to reach that goal. First of all, the sovereign wealth fund should be transparent. This means that its investment strategy and its performance relative to the performance of alternative funds should be easily monitored by every citizen. This would strengthen the democratic accountability of this institution. The second crucial feature of this institution is that it be politically independent, so that it cannot be misused by the government in order to win the next elections. Political independence also includes independence from large corporations and the financial industry that also could benefit from manipulating the investment choices made by that fund. Finally, I argue that such an institution should try to be also a faithful expression of the ambitions of the citizens it represents. The values of the citizens should be expressed by our institutions. And people do not only strive for more material wealth, they have also deep concerns about living in a society with human relationships between individuals and groups. They have deep concerns about a balanced relationship between human beings and nature. And that's why I suggest that the sovereign wealth fund be constrained by ethical requirements regarding its investment strategies. This is something which already occurs in Norway. Norway has got a very large sovereign wealth fund whose investment decisions are bound by ethical requirements defined by a committee. Such a committee established ethical principles, and companies that are thought to infringe those principles are excluded from the universe of investable stocks. So that what I argue is that the sovereign wealth fund should be ethically responsible, and its mission should be to maximize the long-run rate of return, subject to the condition that only ethically justifiable investments are allowed. So, what would be the gain for the polity from such an institution? Well, the entire return earned by the sovereign wealth fund, net of administrative costs and of a reinvestment quota, which would be necessary in order to stabilize in the long run the ratio between fund size and GDP, that rate of return would accrue to the public budget and would be entirely earmarked to finance a social dividend. What is a social dividend? The social dividend would be the new redistributive tool of the polity. It would be a universal transfer payment that every citizen, babies included, would receive on a regular basis, for instance, every quarter. This would be a very important tool in order to reduce inequality and poverty. And it would be the instrument by which every citizen, also those who have no private wealth, can participate in the very high rates of return that are generated by the stock market. Nowadays, we have an insider-outsider divide, not only in the labor market, but also in financial markets. Ordinary savers are fighting for getting positive returns on their savings. But very wealthy investors can earn rates of return of the order of 10%. Okay? Using that mechanism, we would be able to have every citizen participate in those high returns generated by the stock market. How large would be such a social dividend? Well, you should not expect that it would be enough to finance a living. Realistically, it will not. But it will be a matter that is really important for the working poor, for large families. For instance, if we suppose that over time, the capital of the sovereign wealth fund gradually builds up to something like 50% of GDP, say after 20 or 30 years, and it is able to earn a return of 8%, then the public budget would have increased its revenues by 4 percentage points of GDP. Applying current numbers from the US economy, this would generate a social dividend for everybody of the order of $2,300 per year, which is something important for the working poor and as I said before, for large families. So this would be a key institution in order to avoid the polarization of society and to avoid the fact that increasing wealth inequality has an effect on social inequality that is magnified by this insider-outsider divide that I already mentioned. That is to say, by the fact that small wealth owners earn a very small return, large wealth holders earn a very large return. However, a central argument that I gave you at the beginning for fighting increasing wealth and income concentration was to avoid that the political system degenerates into a plutocracy, a government of the rich. And you might argue that a sovereign wealth fund like the one I described would not change very much in this respect, because the sovereign wealth fund I just described acts as a collective rentier, and public ownership plays a very passive role. That is, it does not alter the control structures of our economy, right? But large corporations and the lobbies that represent them are precisely the places where the moneyed elite of a country or of the planet can develop common viewpoints and successfully coordinate on strategies of political influence, right? So that's why I propose that if the experience with the sovereign wealth fund has been positive, then a second step should be tried. One by which a novel institution is created that challenges capitalistic control. A novel institution that contends with some capitalists for the control of some large domestic companies. This is, of course, a part of the program, which is much more ambitious, and that has to cope with the two fundamental issues. The first one is to make sure that those companies that are run by this public institution are also efficient. This is the incentive problem. The second big issue is to determine a meaningful partition of the sector of large companies between what I term public democratic control on the one hand and private capitalistic control on the other. So let me now briefly tell you a few ideas about how to deal with those two problems that I dealt with in the book that was mentioned before, Bessere Welt, which is going to be published in English by Harvard University Press next year. First of all, I've coined the term Federal Shareholder for the institution that should challenge capitalistic control, that should embody the endeavor of the polity to substitute capitalistic dominance by means of democratic control. So this institution, in its beginnings, would control only a small number of firms, a tiny fraction of the sector of large companies of a country or of a continent. That institution would own 51% of the shares of those publicly quoted companies. The remaining shares would be privately held and freely traded in markets. That dual ownership structure would be key in order to solve the first problem I mentioned, the incentive problem, because those public companies would have a share price, and that price would mirror the expectation of the market about the future profitability of the firms, and hence deliver a signal about the quality of current management. And that signal could be used in order to incentivize the managers of those corporations. This is the first reason why such a dual structure is key. The second is that the private shareholders would form interest groups that would also put the managers of the public firms under pressure to run their firms in a profitable way. So the federal shareholder would exert controls by means of the standard laws on corporations, that is, by sending its representatives in the supervisory boards of firms. And in order to be successful, it should have two prominent features that are shared by the Bundesbank and some other central banks. Those key features are transparency of the mission and political independence. The mission should be clear. It should be to maximize the long-run rate of return on the invested capital. Second, political independence is crucial so that the institution be isolated from political pressures, so that even in cases where some public firms needs to be restructured in order to become competitive, the federal shareholder can do it, despite the government may oppose it. Okay? So, what would be done with the dividends of those public firms? Well, the dividends would accrue to the public budget and also be earmarked to finance, together with the returns from the first institutions, the social dividend. This would mean that every citizen would be a stakeholder of that institution and be interested that public firms are run efficiently. So they would have an incentive to monitor the public firms, and that's the reason why those firms should be forced to publish their financial returns and in a way that is comparable to benchmark enterprises. Together with the control by the general public, there should be some institutional control. And now you may ask, what would be the difference between those public firms and the private firms if those firms also should maximize profits? There are two key differences. First of all, we know that profit maximization is socially optimal only if it does not occur at the expense of employees, of customers, and the natural environment. It should be the result of successful innovations in product quality and production processes. That's the reason why the public firms should be subject to an additional monitoring by trade unions, consumer protection agencies, and environmental groups. Those watchdogs of civil society should have facilitated access to all information that is necessary in order to monitor those public firms. The second and even more important difference to capitalistic firms is that the representatives of the federal shareholder would foster worker participation, co-determination, and the identification of workers with their firm. There are good theoretical reasons and supportive empirical evidence for the claim that capitalistic firms provide an inefficient level of worker participation. The reason is that worker participation, voice mechanisms within firms, on the one hand, increase information flows and hence productivity, but on the other also increase the ability of employees to coordinate for bargaining purposes. And that's the reason why a rational capitalist will never go for the socially optimal level of empowerment of their workers, but it will stop before, because he's only interested in the slice of the surplus earned by him and not by the overall size of the cake. So that's why empowering workers is not an additional criterion that should be followed by the public firms, but is the specific way through which public firms should maximize profits and maybe be more profitable than private capitalistic firms. So I come very rapidly also to the second part, to the second problem I mentioned before, namely what should be a meaningful partition of the sector of large companies between private and public governance? Well, there is no magic number. It would be arrogant to claim that we know what an optimal partition is. What we need is an open-ended evolutionary approach that would allow the polity to learn over time what an efficient partition is. For that, we need a fair tournament between the two governance forms. That is, we need that both forms of governance should be treated on equal foot, that all externalities be internalized by the general law framework and taxation framework, and then we know that the relative profitability of firms will mirror their relative economic efficiency. And since capital is attracted by higher profitability, this means that the more efficient sector will expand, whereas the less efficient one will shrink. So that over time, there will be a spontaneous process towards a good partition. And actually, this process will continue until it will reach a point where a marginal shift of governments in the one or the other direction will not be able to raise efficiency anymore. And in that case, we will have reached an efficient, steady state. This is a pragmatic approach in order to determine the right way for a polity to manage its large productive units, its large corporations. This openness of mind entails the possibility that public firms might be unable to deliver the market rates of return, and hence this sector has to shrink, and in the end, the public institution, the Federal Shareholder, has to be shut down. This is possible. If this occurs, we as citizens would have learned that capitalistic dynasties are irreplaceable in the sense that large companies would be less efficient without them. This is possible, but not likely, because private capitalistic firms are ridden with several serious governance problems. Sometimes they are run by incompetent heirs that just love to exert power upon other people. Occasionally they are raided by their own managers, and in general they trust their workforce too little and empower them inefficiently. So that if the incentive structure around the federal shareholder is well designed, I think there are good chances that we may end up with an economic system where this sector is more evenly divided into public, democratic, and private capitalistic governments, and this would seriously counteract the ability of capitalistic dynasty to influence politics, and this would have huge implications for societal development. So let me finish by offering a short summary of my main message. What I have told is the following: the increasing process of concentration of income and wealth at the very, very top of the distribution is a serious threat to our beloved European project of a good society. Capital taxes are not the answer to that problem. They should be very high, much too high, and it will be not politically feasible even to have them. What we need is to rethink in a pragmatic, in an anti-ideological way, the role of public wealth and public capital in a truly free market economy. In order to do this, we have to be creative. We have not to look at the past, but to look forward in the future. We need institutions that may be different from what we know. We need a process of institution building, similarly to what happened, say, in the US with the establishment of the New Deal, or in Western Europe with the establishment of Social Security and many other institutions. Some rebalancement of political power will be necessary in order to start this process. At that time, it was the empowerment of women, the empowerment of the working class that led to a changed balance of power that enabled those political institutions to emerge. Nowadays, I think that direct democracy and empowerment of ordinary citizens as opposed to established political class will be the key ingredient. But if we do that, and we do that in a rational and clever way, designing those institutions, taking its incentive and economic effects into account, I think we'll be able to save the European project of a good society, and we'll be ready for more economic pluralism, a rejuvenation of democracy, and a less polarized society. Thank you very much for your attention.
Thank you very much, Giacomo Corneo. I'm sure there are questions, and I see already first hands over there and over there. So this was very inspiring. Hopefully these ideas will be taken up.
Thank you. I think we should all be grateful for Piketty for forcing us to think about inequalities. And as you nicely stressed in your first slide, I mean, there has been a lot of criticism against his work, both theoretically and empirically. I think that it's interesting to see that there actually exist this type of sovereign wealth funds. And in Singapore, for instance, they have a sovereign wealth funds that has been built up by taxing the population. What has happened with income inequalities in Singapore? It has exploded. So it's clearly not been used to decrease income inequalities. What it has been doing is that it has enabled a non-democratic authoritarian regime to stay in power by handing out money to the population before elections. And I think this brings us to why I disagree with most of the things you have said. And that is that I think we trust the politicians not equally. I think, you know, the idea of having a big bag of money for the government to use in sovereign wealth funds make me nervous. The idea that you should have politicians taking over the large companies in our countries make me almost panic. And it's also the case that if you look at Norway, which is brought up here, well, Norway had a windfall gains in terms of oil income, right? They couldn't use this money in Norway without breaking, you know, disturbing and ruining the economy. But for the European countries, I mean, we have countries here now in Europe which have budget deficits of 3, 4, 5% of GDP, which have public debt as a share of GDP, which is maybe 100%. So if you want to build up this type of funds, you need to, you know, cut down on other type of government expenditures. And I think that would be a mistake. I mean, in my reading, my understanding of these increased inequalities, so at least part of it is explained by the total failure of the governments in European countries to provide things like decent education to low-income households. I mean, it's really, if you look at schools in so-called rough neighborhoods in many European countries, including Sweden, where I'm from, it's shameful, you know. And of course, I much rather see the governments to do something about these things, to give the instruments to the population to make the social climb. I'd much rather see that than the government should pay lottery with the taxpayers' money. Thank you.
Would you like to add your name maybe and also your institution? I mean, everyone, I was asked to ask everyone to say the name and institution to give a background. All right, thank you very much. You want to reply?
Yes.
Maybe shortly.
Yes. Well, this is a very old and pretty boring idea that we should do something for our educational system. So I've been hearing about this, I think, since I've started to be interested in politics. So, by the way, I think that Singapore is one of the countries with the best performance of pupils as compared by international performance scores of student achievement, which is a bit in contrast of what you said. So I think that only Herodes maybe would be against a policy of giving children more chances and better education. So, of course, but this is not very helpful. We know we tried and it failed. I hope it will be better. Otherwise, what you said, that politicians are not trustworthy. Well, I think that we should have a realistic approach to that. That's the reason why I mentioned that it is very important that we have a rebalance of power in society. We have to empower citizens. We have to build a kind of participatory market economy. And there are many institutions. I think Switzerland is a wonderful country in this respect, where we can learn a lot from it. And I think that the challenge is exactly to provide an environment such that those two aspects reinforce each other. On the one hand, having political institutions that promote citizenship, and on the other hand, using the experience that is made by every citizen in participating in political decision-making in order to better control such institutions, such novel institutions, so that they will not be captured by the government. That's the challenge. I think it's a challenge we should take, because otherwise we are at bifurcation point. We are a bifurcation. We are, in the one hand, we are going to have a kind of pacification of most of the citizenry, say, like in the United States. And the other alternative to pacification is participation. And I think this is the good road to travel.
I'd like, in the sense of democracy and pluralism, I'd like to give more people a chance to say something, maybe 20 seconds question, 30-second answer. Would that be okay? Okay. So,
Gerd Volkers, Kollegium Helveticum Zurich. So along the same lines, I'm not talking about education for children only, but also for adults. As we know, every participatory model relies on education, or the German word Bildung. And so the question is where to get the time for this bill, and what is the responsibility to have it, and the self-responsibility to have it. So if you talk about the attractive system of publicly democratic controlled large firms, you have to avoid that the public fraction that controls the company gets as greedy as the manager that you depicted in your little bit black and white scheme of good workers and bad managers. So we had this with the pension funds. We have now Volkswagen, which is not publicly owned, but has quite a large fraction of the country of North Rhine-Westphalia that is sitting in the board. So then my question, shouldn't we have a fundamental reorientation then of the whole education system to make children and adults get fit for these demands that in principle sound very good, but the practicality, I doubt a little bit in the design.
Well, I will be brief this time. So yes, I think that there are many signs in civil society that show that there are many people that are interested. So look at people doing voluntary work in social institutions. Look at people voting with their wallet, not only as consumers but also as investors. So the demand is there. I think we should try to promote that demand by suitable institutions. In the book, I have some concrete proposals how to do this at the local level.
All right, so there's already the next question.
It was a great talk, and it was very interesting to listen to you. But always, if one hears such ideas, so one thinks about, why don't you scale the model? So if it's so good, make it 10 times as large or 100 times as large. So we can finance everything with it, because when it brings money, then of course it should be much greater. The answer is, why shouldn't you scale it? Because it doesn't work, of course. So we have experience with it in Switzerland. We have pension funds of 800 billion Swiss francs. That is 120% of GDP, so it's much larger than what you propose. But now you propose an additional thing. It's let's leverage the system. So if everybody in Switzerland agrees it's good to have this capital-funded pension system, but if you ask people, should we leverage the system? Everybody says, are you crazy? So why should we take money from the market and invest it in stocks? Why should this work? And the answer is, oh yeah, of course you gave all these numbers, but the answer is, so why should an insurance firm, or why should a bank give money to the government when it's so easy to make so much money with it? So everybody, of course, would make money himself, and would not give it to government. That's the first point. The second point is, of course, banks tried to do it, but it didn't work. So banks lost a lot of money. The canton of Aargau in Switzerland tried to do it. They lost a lot of money. And so a third aspect is, if government is doing it, of course, the interest rate for normal capital is going up, and the returns on equity is going down. So if it's so large, your fund, as you think it should be, then I think it doesn't, just from this equilibrating mechanism, it's even worse than when today insurance firms would leverage themselves and would lose the money. So it cannot work just from this. And there are several, of course, other aspects, but we should discuss afterwards.
Yes. So, of course, one should take into account the general equilibrium repercussions of such a strategy, but I think it is straightforward to see that by having a meaningful combination of the instruments, so because I had no very much time, I only talked about the role played by new government debt. But of course, there are also the two other instruments. And having a meaningful mix of those two instruments would easily solve all the problems that you mentioned. In particular, if a very large country like the US would go for this would have, for instance, an effect on the equilibrium rate of interest worldwide. So, and this, I think, would be something that is likely to be positive for macroeconomic reasons. So even the Fed is suggesting something like this. And all the other points you mentioned, well, of course, there are huge differences between a borrower like a government of a solvent country and a bank. So it's the monopoly of violence is the prerequisite of the government, and the use of taxpayer money in order to repay the government is what makes that a country like Germany pays no risk premium on its revenue. So that there are margins, but of course I'm not claiming, I never claimed that there are no limits. So I think that there will be limits, and it is an empirical matter to determine those limits. But I think we could go pretty much on that direction before we reach the limits, such that the equity risk premium would be narrowed down to very, very low.
I'm afraid that we need to stop the discussion over here. I'm very happy about the controversial discussion that we are having over here. I think it will continue over those days. Please stay in touch, because that's the way to learn about new ways to tackle our problems. Thank you very much, Giacomo Corneo.